What is going on, YouTube? Hope you guys are doing great. So just about once a month, I will go through like 2 or 3 different scanners that I've set up online through a couple different subscription services. And I'm looking to see if there are any companies that happen to be out there that month that for whatever reason their stock took a hit. They're in an industry that I understand and they happen to be selling at a fat discount. And to tell you the truth, guys, most months nothing ever shows up, and that's simply because I set these scanners with pretty high prerequisites. These are typical Warren Buffett like picks that are selling at a great entry point. And not only does that limit the number of stocks available to me, let's face it, I'm a young investor and my circle of competence really isn't that big. There's only like 2 or 3 industries that I truly understand, like e-commerce, home building, which we're gonna get into, marketing services, and anything having to do with e-commerce. When this stock came up that we're gonna talk about today, I got really excited because it really only happens like I'd say once every 4 or 5 months that something shows up on these scanners. So about a month ago, maybe a little over a month ago, I was going through my scanner and a ticker called MTH Meritage Homes popped up, and I saw the industry that it operated in and I saw that it was home building. And I was already like, interesting, because with my day job, I actually do marketing for a home builder. So I feel like I know quite a bit about the home building industry. I know the trends, I know about lumber shortages, I know about first-time home buying being on the rise, millennials are demanding homes. I could go on and on. So I was already like, okay, that's something in my circle of competence. Let's do some more digging. So usually the next thing that I will do after I see something in my scan is I'll go over to my Phil Town Rule 1 toolbox, which if you guys don't know who Phil Town is, go read his first book, Rule 1 Investing. It is the ultimate beginner's guide to value investing and learning how to treat stocks as a business owner. That's where I started, and I wouldn't know nearly as much as I know today without that book. And obviously his second book too was great too. But anyways, I'm getting sidetracked. So I went into his toolbox that I pay $30 a month for. If you start getting serious in investing, I highly recommend that subscription. It's great. And I plugged in MTH and I saw that the Rule 1 score was all green. I hadn't even looked at the numbers yet. And this is essentially telling me how well the company has done over the past 10 years. And when it's just all green, you know, sometimes I'll plug a company in there and it'll just be all red, or a mix of green and red. It'll look like a Christmas tree. It's just a thing of beauty. I nerd out over it. I hadn't even looked at the numbers yet, but I was already getting really excited. So the next thing that stood out to me was how well management was doing, at least based off of the metrics I saw for return on invested capital and return on equity. So this told me that they've been really consistent and they have been doing a really good job of taking their earnings and reinvesting those profits into even more profitable projects. Now, one note, you should always look at those numbers kind of with a grain of salt. Really should, in my opinion, try and figure out what the firm's cost of capital is, which if you don't know what that is, real quick, it's kind of like a weighted average of how much debt from the banks the company takes on and how much equity the company takes on. You're trying to figure out how much it costs the company to borrow money to do their business operations. And if that number is higher than what the return on capital is, you should probably stay away from the business. So by now I was like, okay, at least on a surface level view here, this looks really interesting. How much is Meritage selling for? And I scrolled down, and the first 2 ratios I like to look at, which pretty much determine if I'm going to keep researching this company or if I'm going to keep doing more digging, is the PE ratio and the price to free cash flow ratio. I saw that the PE ratio at the time was like a 7. I think it's an 8 now. And I saw that the price to free cash flow was a 7 as well. And I think that's actually about an 8 as well too. Immediately I started thinking, okay, this sounds too good to be true. What's the catch? What's going on? Why is this stock so undervalued? So the next thing I wanted to know was its liquidity situation. And usually if I want a quick answer to those questions, I want to know what the current ratio is, and I want to know what the debt to equity ratio is. And just for context, guys, Warren Buffett usually prefers a current ratio over 1.5 and a debt to equity ratio under 0.5. So to find this out, I simply went over to Morningstar. I plugged in MTH into the search bar. I then went to the key ratios tab, and then I went to the, I think it's the liquidities ratio tab. It's easy to find. And then the number I'm looking at is the trailing 12-month number. So it's the one in the far right. And I saw that for the current ratio, it was 1.8 and the debt to equity ratio was 0.4. You better believe my heart was starting to race. I was like, okay, let's get this 10K up. I want to start doing some digging. But before I was going to spend a bunch of time going through one of those big, long, boring 10Ks, I decided I was going to look at the consistency of the financials. Personally, I do not like investing in companies where 1 year their revenue and earnings are through the roof and 1 year it's down. I like a nice even growth line. You'll see with pharmaceutical companies and biotech companies, this up and down stuff. For me, I'm not smart enough to predict and value those types of companies. I need a nice even playing ground there. It makes my job as a value investor a lot easier to predict the financial future of this company. The number that I care the most about with this consistency is revenue. Guys, the reason I like looking at revenue is because it's really hard to fudge revenue. And what I mean by that is that accountants are really, really smart, way smarter than me. And usually they know exactly what analysts are looking for. So typically if there's an analyst covering an individual company, then that analyst is gonna wanna know every quarter what the company brought in earnings. And if there's a quarter where earnings went down, that analyst is gonna write about it and the stock is gonna take a dip. So accountants know that and they always try their best to adjust the book. You know, they'll amortize some stuff, they'll throw goodwill. I don't even know how they do it. I'm not a good accountant, but I do know that they're really good at fudging the numbers to make that bottom line number meet these analyst demands. So that's why I look at revenue, because yeah, it's true, some companies can defer revenue or recognize revenue early even though the service hasn't actually happened. Most companies don't do that. They record revenue when it's supposed to be recognized, once there's a transaction that has happened. So I looked at the numbers over the past 10 years and I determined that they have been compounding revenue growth by just about 20% for the last 10 years, which is pretty crazy. And of course, this isn't sustainable because all businesses go through cycles and we would expect that it would mean revert and get back to the industry average growth. But it was a great start. It was really interesting and great to see that. So usually if a company is able to punch all these check marks, I'm going to do just a very quick high level discounted cash flow so I can get a ballpark estimate of what I think it's worth. And this is very high level. This is not what I probably am gonna end up thinking it's worth, but it's gonna determine if it's gonna be worth my time to start reading the 10K so I can make a really good intrinsic value assessment with my other spreadsheets that I have created that take a long time to fill out. But anyways, I wanna go over the computer and we're just gonna do a quick valuation of this company so you guys can maybe learn how I value these companies and so you can get kind of just a high level intrinsic value of this stock. So anyways, let's go over to the computer real quick. Guys, what's going on? I think I'm getting better at these screen recordings. Hopefully there's nothing embarrassing on my computer, but we will find out. All right, so let's just get right into it. So if you watch my Alibaba video, I talked about discounted cash flow valuation, and I'm really quickly gonna go through this and the discounted cash flow valuation I did for Meritage here, but I really wanna get into the 10 cap valuation because I didn't have enough time in the last video to go through that. I mentioned in that video, there are like 5 or 6 different ways I value a company, and these are like 4 of them, and then there's about 2 others that I use with an actual Excel, not Google Sheet spreadsheet. So I'm talking really fast, but I'm trying to make this a quicker video. So anyways, I'm just gonna run through this. If you wanna know how I pull these numbers, watch the Baba video. I go through this, and if you wanna understand the mechanics here, watch that video. But anyways, I'm going with a 13% growth rate for years 1 through 5. I just said in the previous part of the video that they have been compounding at 20%, and I expect that to revert to the industry average, the mean. So we're gonna do 13 there just to be conservative, and then 6 through 10 we're gonna do 7%. And like I said in the last video, I'm really stingy with my discount rate. With Bob I did 12, but this company is smaller, not really as established, not covered nearly as much. So I'm using a 15% interest rate. That's how you can think about that. I need that rate of return for me to even think about making an investment in Meritage. I'm also being conservative with my terminal value. So we're gonna do a terminal value or a multiple of 10 on year 10 free cash flow. Debt, if you look at ticker terminal, it's about $1 billion, cash 745, shares 37. So you'll see, unlike Alibaba, that was net cash positive, there's more debt here, which is fine, it's okay. It's negative, but as business owners, which we are, as shareholders, I really want to ingrain that into all of you guys to start thinking like a business owner when you think about buying a piece of stock. This is actually going to end up impacting our valuation down here. The enterprise value, according to the ticker terminal, is about 3.9 billion. Free cash flow is 510. So I just took cash from operations minus capital expenditures. Said in the Baba video, it's not really the most accurate way to get free cash flow, but you can do it that way. You can also look at Morningstar, go in the key ratios tab, free cash flow pops up if you just want a quick estimate of free cash flow. So anyways, we grew the free cash flows by 13% years 1 through 5. What did I say we did here? 7% through 6 through 10. And we applied that multiple of 10 to the free cash flow. And we're coming up with an intrinsic value of the entire company of about 6.4 billion. And if you're Warren Buffett, he's going to look at this number right here. As he always says in his videos, the intrinsic value of a company is the discounted present value of all future cash flows. So he's looking at this number and he's comparing it to this number right here. And as you can see, this is clearly undervalued because we think it's going to be worth this in the future. Right now it's selling at that. If you want to divide it by the shares outstanding, you can, and we get 172. And I talked a little bit about margin of safety in the Baba video. I'm probably gonna have to make an entire video dedicated to that because it's very important to buy with a margin of safety. I will only buy a company if I can get at least a 40% margin of safety, unless one of the very few guru investors I look up to, like Charlie Munger, bought a company, then I might consider going with a smaller margin of safety because they are smarter than me and I will trust them. I'm not going to touch on payback time. I will make the spreadsheet available, but you can go through this and look at it. But I want to get into 10 cap, and this supposedly Warren Buffett has said in shareholder meetings that this is his preferred way of valuing a company. He does talk about discounted cash flow and how you can do it that way, but he likes to value stocks very similarly to how you would value real estate. So I guess before I get into this, if you're going to buy a home that you aren't going to live in, but you're going to rent out Airbnb or have tenants, and let's say you buy it for $100,000 and you think you can get $20,000 in rental income from it, your return is going to be 20%, right? Basic math. So that's essentially what we're doing here. The big difference is we're not applying that growth rate and we're not applying a terminal value. We are valuing the company as it is today. And I need to give a big shout out to the Stock Compounder channel, Brad Kellner and his channel. I learned this, and I'm not gonna lie, this is pretty much his spreadsheet from him and his great content. I actually was kind of motivated to make stock videos because of him. So go check out his channel. Shout out Brad Kellner if you're watching. I doubt you are, but thank you for teaching me this. So anyways, 10 cap price valuation. So essentially what we're doing, so instead of taking a growth rate and a terminal value, we're looking at what the owner's earnings are, which is the amount of cash that can go into the owner's pockets every year, guys, without affecting normal business operations. So these are just cash flows from day-to-day business operations. These aren't one-time expenditures, one-time bridge loans. These aren't weird restructurings. This is purely from how the business operates and what it does. So like I said here, cash that isn't required to keep the business running. It's excess cash. So how do you, real quick, so 10 cap, we're taking that owner's earnings and we're multiplying it by 10 years. We want to see what it's going to be worth in 10 years if we take today's owner's earnings and multiply it by 10, which is a very efficient way of getting a rough estimate of intrinsic value. So sorry if there was a weird edit there or an awkward transition. My dog was barking. I had to shut him up. But anyways, okay, how do we calculate owner's earnings? Well, we're simply just going to take operating cash flow, which we get from the cash flow statement, minus maintenance capital expenditures. And we get that from the cash flow statement. However, this is important. What is maintenance capital expenditures? Well, capital expenditures can be broken down in many different ways. But we want to know the capital expenditure costs that are going to keep just daily business operations going. So investments in property, plant, equipment, and stuff like that. We don't really care about the capital expenditures that are going to be used for growth initiatives. So stuff on research and development. And unfortunately, guys, if you go through a 10K and you get to the capital expenditures part, most companies, some do, but most companies aren't going to break that down. I wish they would, and I wish there was a rule that said you had to, because I think that's important to know. But Phil Town in a podcast said that just a simple rule of thumb you can use to figure out what maintenance capital expenditures is just to take the total one, the number they give you, and divide it by 2. So that's what we're going to do. And then we're going to add back the income tax provision. Why? Well, there's nothing really you can do about taxes. That's just the way it is when you run a business. It doesn't really impact, or it doesn't have anything to do with the business operations, which that is what we're trying to figure out. So I did make a note here. Make sure you look back at previous 10Ks to see if this year's capital expenditures was an outlier. You want to kind of make sure that the CapEx is consistent or it's growing at a rate that's consistent with revenue and the rest of the numbers, because if you have an outlier, that's going to impact your margin of safety and your valuation here. So anyways, I touched on enterprise value in the BABA video, but real quick, if you want to figure it out roughly, you can just take the market cap, so shares outstanding times the share price, then you add back debt, add back minority interest, and you deduct cash. But anyways, so I got all these numbers from Ticker, and I went on to look at the 10K later, but these ones are straight from Ticker. So operating cash flow was 553, capital expenditures, total CapEx was 20. Like I said, we're going to divide that by 2 to figure out what the maintenance CapEx is, what they put into just continuing business operations. We added back the tax provision of 110, and we figured out that 2020 owner's earnings was about 543. So that's really good. And then we simply took that number, multiplied it by 10 years, and that's kind of our number for intrinsic value when we use the 10 cap valuation. So what we naturally do is we compare it to today's enterprise value, what it's selling for today, and you can see it's undervalued. So that's cool. Both the discounted cash flow valuation and the 10 cap valuation is indicating that it's undervalued. Essentially, this is kind of like what I was talking about with when you buy a home. This is the return that you can expect every year for the next 10 years. So be it that they continue doing what they're doing. They don't have to grow. This is, if they can just maintain 543 over the next 10 years, you can expect a 14% rate of return, which, considering the market does on average, last year was a weird year, a really good year for the market, but on average does about 8 or 9% per year. You would be beating the market if this valuation was accurate. If you wanted to figure out your margin of safety here, you can. So it's kind of selling at a 30% discount, well, almost 30%. So you can think about that like a 30% margin of safety. So I think that's all I'm going to say here. Maybe in the next video, we'll talk about acquirer's multiple. I know in the last video I said I would touch on that in this one, but I got carried away again here. So yeah, guys, I have been researching this company a lot. I've read the 10K many times over. I've learned about the management team. So if you guys want a part 2 and you want to learn about my bullish thesis on it, and how they are going after millennials who are first-time home buyers, and how I think personally this company is positioning itself to be one of the industry leaders in home building over the next 10 years, then let me know. Leave a comment. I would love to do a part 2. Again, guys, I am still just kind of doing a shotgun approach here, trying to see what you guys want. If you guys want to learn about cultural stuff with materialism, I'll do that. If you guys want me to keep doing more stock reviews, if you want me to teach you how to set up a discounted cash flow, if you want me to show you my big spreadsheet, I will. Let me know. I'm having fun doing this so far. So anyways, guys, if you made it this far, you are awesome, and I will see you guys in the next one.